Hello, and thank you for joining me for my latest video designed to give you some insights and guidance regarding your finances during the coronavirus lockdown. Since making my last video, I've had several conversations with contacts and clients about investments, and the general comment coming from the advice sector, which is not to panic and to remain invested. The questions were surrounding the rationale behind this general comment and whether this means there is little going on while we wait for investment markets to recover. With this in mind, this communication is designed to give a little more colour around current thinking and the rationale behind the advice to remain invested. It is important to mention at this stage that this communication is designed to provide information and background only and should not be seen as personal advice. If this video does raise any particular questions for you, I would urge you to get in touch with us, and there'll be some contact details for you at the end. Before looking at what is going on behind the general comment to stay invested, let's first think about some of the context behind these types of discussions, much of which is the result of worry. At this moment, the coronavirus has generated a real fear amongst the population. Whilst many of us would have seen investments fall before, such as during the financial crisis of 2008, never before has this been coupled with a genuine fear for our own health as a population. The financial impact of the coronavirus and the lockdown has been widely reported, and many people will have experienced falls in value of their portfolios in excess of 10%. It would be true to say that the current press coverage will have fed into and exacerbated a lot of these fears. The problem that often happens when people are genuinely worried is that we react instinctively to things. For example, we buy more food and toilet rolls when we don't really need them, based purely on the fear that if we don't do it when we see dwindling supply, there might be none when we need it, even when we know that more supplies are coming. So when we apply this same fear of loss to when we look at how people react to investments, there is a definite correlation to this behavior, as when people see their investments drop, they fear it will never come back. And often without advice, many run to cash based purely on that very fear. The advisor's job here is to help you stop and take stock, effectively giving you pause. Our role is to use our experience, knowledge, and objective viewpoint to help you avoid rushing into what could be a bad decision. So what does remain invested actually mean? On the face of it, the comment is simply the tip of a far larger investment process iceberg. And while on the face of it, your investment portfolio could still likely be called the same thing it always has been, under the surface, the portfolio could look very different, as there is far more thinking going on under the surface to reposition portfolios to benefit from prevailing investment markets and any potential recovery. To give some insight into this, I'm going to look back to previous large market falls and then give a quick overview of some potential COVID-19 recovery scenarios that are being considered. I don't propose to look at the granular research done by investment managers, as this will take too long, and different managers will interpret the data and position portfolios differently. This is, however, designed to give some context to the recent investment market drop and what could happen. Before going on, I must firstly thank Vanguard for allowing me to use their slide, which shows data relating to the FTSE All-Share calculated since the beginning of 1900 up until the end of 2018. What this shows are the bear market periods, which is where the price has dropped by more than 20% from the previous peak, and the bull market periods where the price has risen by more than 20% from the previous low point. The values quoted along the chart are the largest percentage fall or rise during the bull or bear period. Importantly, this shows the periods being quoted by the press at the current time when they are contextualizing current markets against historic markets, be that them considering the Great Depression, the 1987 Black Monday crash, the tech bubble bursting in 2000, or the 2008 financial crisis. You will note that all of these bear market periods lasted for differing periods before markets recovered, and all of which caused similar panic and concern around investments as we are seeing today. What you can also see, though, is that markets and investment values do recover. By exiting at the low point, there is the risk of not catching the recovery. Looking at this data objectively, would you want to exit your investments at the lower point or the higher point? And when here would you have preferred to have invested your cash? Well, it's easy. It is an easy objective answer, as hindsight vision is always 2020. However, when markets fall, it is just as easy for objectivity to disappear and for fear to kick in, as we're seeing at the moment. In reality, it is impossible to time markets, as no one will ever know when the top or bottom of the market really is. This is why financial advisors and investment managers will always say that with longer term goals, it is time in the market that is key to driving returns, not trying to time the market. This data highlights that adage better than anything. It is the fact that over the whole 120-year time frame considered here, markets did recover after the downturns, and there have been over 103 bull year periods and just 16 bear years. Interestingly, the better times in the bull markets receive far less press than the bear market drops. Market drops like those shown here and the current coronavirus are the reason why it is always a sensible idea to maintain a reasonable cash holding. By doing so, your cash can provide your standard of living while your investments ride out the volatility. The question then is, how long will this period last? And what will the recovery look like? Well, okay, this one comes with a very big caveat, which is nobody knows what the economic recovery will look like. And in many ways, it will depend upon the way in which the UK and the world can combat and contain the coronavirus. Whilst appropriate for this video, it's perhaps overly simplified to say that the quicker the reinfection rate reduces and the much discussed curve flattens, the sooner we will be released in some form from lockdown over future months and life and the economy can start to bounce back. This gives rise to names like V-shaped, U-shaped, or even L-shaped recovery, which is effectively what the lines on an investment chart are likely to eventually look like. This recovery analysis is one of the early steps and pieces of analysis of literally dozens which are taken by portfolio managers to help them then reposition investment portfolios to their best advantage. So what does this initial stage analysis look like? Well, to give you an idea, I must thank one of our shortlisted discretionary portfolio manager panel members, 7IM, for allowing me to share some of their scenario data. This data considers differing sets of circumstances and focuses on the US. This is different to the back-tested data considered a moment ago. This scenario data tests economic output or GDP data. Whilst these predictions will feed into investment markets, this chart is not making investment market predictions. Now, I must stress that this is purely 7IM's data, and other managers, while having undertaken similar scenario tests, will interpret the data differently. However, this chart shows the differing potential recovery rates based on 7IM's projected data, and then to give some context, it overlays the 2008 financial crisis for comparison purposes. This data considers a number of scenarios, from a V plus recovery, where the current medical plans go better than expected, to considering different effects based on differing views of the measures becoming less effective, all the way to the L-shaped recovery based on lockdown measures struggling to contain reinfection rates and remaining in place for a far longer period, with the only solution being to lift the lockdown in some form and get the economy working again. Well, the only way to do it will be a vaccine. What is interesting in this slide is that compared to 2008, the economic impact of coronavirus is clearly harder and faster felt. However, in each scenario considered, you can see here that the recovery is also faster felt than it was in 2008. Now, that chart was based on only one factor, which has been scenario tested based on current scientific data and the impact of the economy. There is also a huge amount of further data that is considered by investment managers on a daily basis, again under the surface, to ensure that client portfolios are competitively positioned. But as I've already mentioned, the granular detail of this is not appropriate for this short video. So, how does this translate to your own investments? Well, this question is far too specific for a more generic presentation such as this, as different portfolio managers will interpret data differently. And in truth, all are working tirelessly to position individual portfolios to provide returns based on given risk parameters. This is so that even if the stock market remains at a lower level for a period, there are still opportunities for returns until markets recover. The point, as mentioned previously, is that it is time in the market and not market timing that will drive longer term returns. It goes without saying that we at Partners Wealth Management would be happy to discuss your investments with you. We are constantly in discussions with all of our independently selected portfolio manager partners, and we and our third party research partners at Asset Risk Consultants are constantly monitoring what they and the wider market is doing to make the most of opportunities. This means that if you feel your investments do need attention, we can help and offer guidance. So, as you can see, the face value comment of remaining invested if you can is really the tip of a far larger and deeper iceberg. There is a huge amount of work and detailed research happening on your behalf under the surface to ensure that you receive competitive returns while being mindful of cushioning any potential falls as far as possible. I do hope that this communication has been able to give you a helpful insight. As ever, if you have any questions regarding this, would like to get in touch, or if there is a particular topic or subject that you feel would be useful in a further update, please do contact us. And please do feel free to like and share this amongst your friends, family, and contacts if you feel this would be beneficial to them. Thank you very much.